Hi, I'm Michael from Investor Talk and would like to discuss economic indicators. Economic indicators are crucial for understanding the health and direction of the economy. They influence market sentiment, corporate performance, and investment strategies. Here's a deeper dive into the key economic indicators. Inflation. Impact consumer purchasing power. High inflation erodes the purchasing power of consumers, making goods and services more expensive. This can lead to reduced consumer spending, which negatively impacts businesses, especially in the consumer discretionary sector. Corporate costs. Companies face higher input costs like raw materials and labor, which can squeeze profit margins if they are unable to pass these costs on to consumers. Interest rates. Central banks like the Federal Reserve often raise interest rates to combat high inflation. Higher interest rates increase borrowing costs for consumers and businesses, slowing down economic activity. Current scenario: persistent inflation pressures driven by factors such as supply chain disruptions, labor shortages, and increased demand can create a challenging environment for both consumers and businesses. Central banks' responses to inflation are closely watched by investors as they affect market liquidity and borrowing costs. Interest rates. Impact: cost of borrowing. Higher interest rates increase the cost of borrowing for businesses and consumers, leading to reduced investments and spending. Conversely, lower rates make borrowing cheaper, stimulating economic growth. Investment choices. Rising rates can make fixed income investments like bonds more attractive compared to equities, potentially leading to a shift in investor preferences. Currency strength. Interest rate changes can influence currency values, affecting international trade and investment flows. Current scenario: central banks may raise rates to curb inflation, impacting sectors sensitive to borrowing costs such as real estate and consumer discretionary. Investors closely monitor interest rate decisions for indications of economic policy direction and market impacts. Employment data. Strong employment figures indicate a healthy economy with robust consumer spending, as more people have income to spend on goods and services. High employment rates boost consumer confidence, leading to increased spending and economic growth. Low unemployment can lead to wage inflation as businesses compete for workers, potentially contributing to overall inflation. A robust labor market with low unemployment rates supports economic growth and corporate earnings. However, labor shortages in certain sectors can drive wage inflation, contributing to broader inflationary pressures. GDP growth. Positive GDP growth indicates economic expansion, which typically boosts investor confidence and market performance. Negative GDP growth signals a recession, leading to market downturns and risk-off sentiment. Higher GDP growth generally leads to higher corporate earnings as businesses benefit from increased consumer and business spending. Steady or accelerating GDP growth is a positive sign for markets, indicating economic strength and potential for corporate profit growth. Investors monitor GDP reports for indications of economic health and future market direction. Conclusion. Economic indicators such as inflation, interest rates, employment data, and GDP growth are critical for understanding market dynamics. High inflation and rising interest rates can dampen consumer spending and corporate profitability, while strong employment and GDP growth indicate economic strength. Investors use these indicators to gauge economic health, adjust investment strategies, and anticipate market movements. Staying informed about these factors helps navigate the market effectively and manage investment risks. Please note that this video is not for financial advice. Like and subscribe for more updates. Thank you for watching and have a nice day.